All right, so today I wanted to make a video on the top big tech stocks, specifically the top 5 companies in the S&P. Apple, the first one here. The first thing I would mention is if I were to pick any of the 5 to hold for the next 20 years, I would pick Apple. And that probably is not a popular choice. The reason simply being is that I'm the most confident in them long term, and I'll get into the reasons why. I mean, they have arguably the most well-recognized brand in the world, right? That's the main reason. The other reason is they pay a dividend that they're growing very nicely. Well, 5.5% a year. That's not great, but I mean, if you go back 10 years, you're looking at a 6% yield, right? So that's a pretty good yield, especially for a company I still think has room to grow, right? Now, again, they are a big company, but you're not going to get the returns that you got over the last 10 years. Not going to happen, but I still think you can get very solid returns. They're growing they're buying back shares very consistently also, which I like. Just massive amount of shares, right? Crazy amount of shares. And they've been growing that number over time very consistently, right? I mean, 2015, 34 million, 2022, 89, right? So they're growing that very nicely. The dividend payments are going up over time. That's what I like there. Again, if you look at the insights here, growth, it's limited right now, but again, Apple is a little bit cyclical, right? When they get a new iPhone out or a new product or whatever, that's when they really do well, right? And again, if you look at their returns, they're very good. They're very profitable. They are a little expensive right now. And the other thing I didn't mention that I should have mentioned right off the bat is I'm not necessarily a fan of any of these stocks right where they're at right now. I think they're all either very expensive, and I'll get into which ones I think those are, or they're about fair value. Apple, probably about fair value. Google, probably about fair value. Amazon, probably about fair value. And the other 2 are expensive, and one is very expensive. And let's get into the next one here. Amazon, I think Amazon's probably, I mean, they are the most well diversified, right? I mean, they have several large businesses, right? I mean, they got their brick and mortar, order stuff online business, right? They got their Amazon Web Services business. They got their, they got a massive real estate. I mean, how many warehouses do they hold, right? So again, they have several different businesses baked into one essentially, right? And that's why I like Amazon. But again, their numbers are thrown off a little bit too, in that how do they actually report a lot of this stuff? So that's why they don't have great insights here. But again, they've always been like that, right? They've always been like that. And I find it very hard for a company like this not to do at least decently well over the long term, right? The problem is comparing some of these companies to the indexes is a lot of these companies already make up large percentages of the index, so it's kind of hard to compare them, right? Amazon has underperformed the index over the last 3 years, and five years they're about right where it's at. I think that these companies they'll roughly keep up with the index because the indexes move so much when they move. I think it's going to be very hard for them to overperform them to a significant degree, but I also think that it's going to be very hard for them to underperform, right? So long term, I think that these companies are very safe. For a stock, they're very safe. The next one is Microsoft, right? Microsoft, a very good company, right? The only problem with Microsoft is they're too expensive, right? I mean, they have a 41 price to free cash flow. If their 5-year average is 31, I mean, if they went down to 30, I'd probably consider picking up a position. If they had like a 20, I'd be just all over myself, right? But they're just way too expensive where they're at right now. They're a very good company. They're growing their dividend nice. They're just way too expensive, right? They're also buying back shares, right, which I like. Not to the degree that a Google or an Apple is, but that's the key, right? When you're buying a company, they need to be providing value, and preferably very good value, right? Because if they're just providing a little bit, well, you might as well just buy the index, right? If you're investing in individual companies, you want to invest in them because you think they're going to outperform the index, right? And I don't like buying companies that are very expensive because it's harder for them to outperform the index, right? Good companies that are cheap, it's more likely that they are to outperform the index, right? The next one is NVIDIA, right? They're actually the fourth biggest company in the S&P, although that's because Google is separated into Class A and Class B, which is crazy how big this company's got. $782 billion market cap. Like I say, just utterly insane. And this company came down as much as down to about 108 within the last year. It is up to 318. So again, if you bought this company at the low there, congrats. But I never bought it there because it was still very expensive there. And I'll show you why, right? Right now, it is a price to free cash flow of 205, right? The 5-year average is 64. That's still crazy expensive, right? Price to sales of 29. 5-year average is 17. That's still crazy expensive, right? You are gambling, in my opinion, to buy a stock like this. Not that I don't think it's a good company. I think it's a solid company, but I think it's worth maybe $100, maybe probably not even, right? I would be waiting until this stock went below $100 to be buying it, right? So, I mean, this is probably not a bad stock to be buying some, or to be selling some cash secured puts on, right? Although you still got to be careful with that with companies that are very expensive because they could come down a lot, right? Companies that can go up a lot can also come down a lot, right? So that's the thing that I would be concerned about when it comes to NVIDIA. Very good company, but I think it's just crazy expensive, right? And I mean, they're not even really growing that dividend, which is kind of a bummer to me. I mean, that's something that I would really like to see, but they're not even doing it. So this company is just way too expensive right now. I mean, what's their free cap? Their earnings yield's only 0.5%, which is not good, right? I would, of all the companies in that I'm going to talk about, there is only two that I would really stay away from right now, and by far number one is NVIDIA. Number two would be Microsoft. The other three, like I said, are about fair value in my opinion. Apple maybe a tiny bit over, but you could make that argument definitely. But the other three are about fair value in my opinion. The last one is Google, or otherwise known as Alphabet. This one's very interesting. Google is very interesting because I think that there's some concern when it comes to regulation and whatnot from the government, but also like they're a very consistent business and they have very strong margins. I mean, let's go check out some of these margins here. They have like 22% return on equity, 22% free cash flow margin, like 55% gross margin. Like those are very good numbers. And I wish they would pay a dividend. Like that's the one thing I wish about all of these companies, even if it was very small. Like pay a small dividend, grow it 5 to 10% a year. Like that's really all I ask, right? I would rather them do that than massively increase share buybacks. Like do a little bit of both. At least that's my opinion, right? Analysts are fairly bullish. Google's a solid company, like very solid. The one concern, like I said, is regulation. Let's check out their valuation right now. They're actually below, right? Their 5-year average is 29. They're at 25. They went down to about 17 or 18, I think, at one point. So if you could get them below 20, I think that that's a steal. But like I said, I think the big problem with these companies is that they're just so big. And the room to grow is not that much, right? I mean, there's room to grow, but and that's why I want to buy. That's why I like Apple, right? I mean, they're paying a dividend, they're growing it. Microsoft is too, but they're expensive, right? They're expensive, right? The key to buying quality, to being good as an investor, is to buy good companies at a good price. Now, again, there's a lot that goes into that, right? But they're like I say, like you should never overpay for a company, right? You should never pay significantly more than the 5-year average, right? In my opinion, you should probably never pay more than a 30 price of free cash flow. If they're growing like insanely quickly, like a small to medium cap company, maybe you'll pay 35 or 40. But in my opinion, that's just the max, right? That's just the max. And I think that throws a lot of people off, is that they think, oh, it's a good company, but they pay way too much for it, right? So that is my thoughts on the big tech companies, right? I mean, I could go deeper, but those are the main ones. So again, if you like the video, hit that like and subscribe. I'd like to hear comments, feedback, anything would be very much appreciated. So hit that like and subscribe, and stay tuned for more.